Okay, so we have now made the dive into earnings season. The big U.S. banks we were just talking about coming out with their quarterly results. Let's get some more perspective from Robert Webb, portfolio manager at Hamilton ETFs. Good to see you. So we've started off earnings season with these big players on Wall Street. Any general takeaways so far?
Results have been quite good for the two banks that I'm focusing on today, JPMorgan and Citigroup. Both beat quite comfortably. Beats have been delivered as a consequence of, to some extent, good trading and global markets and investment banking businesses, but generally strong across the board.
And I mean, is that an indication to you? Like, we keep talking about the broader fact that the stock market's at an all-time high, just hit a new intraday high this morning, that investors are taking the trade headlines with a grain of salt. If you can see actual business activity taking place, including in deal making, do you think that's sort of an encouraging sign, if you will, given that everyone's said uncertainty 1 million, 2 million, 3 million times this year?
I think that certainly for the trading books, there's been more volatility, and that's a good stimulant for earnings and revenues. For the investment banking, the pipelines are still materially fuller than the activity level. But I think what happened is guidance had been for relatively weak investment banking in the second quarter. I think everybody had been all bulled up at the end of 2024. And then with tariffs, expectations lowered. Banks led people to believe that investment banking activity would be down, and that's actually been marginally up, like 7 to 10% for JPMorgan and Citi this quarter.
So let's compare the JPMorgan story to the Citigroup story by comparison. What stands out with Citi?
In terms of earnings, Citi had I think, a very strong quarter. All 5 of their key businesses showed positive operating leverage, which is precisely what you'd want for a company like Citi that is currently focusing on efficiency and trying to drive greater efficiency and earnings through use of existing assets. Their cost control is very good. For JPMorgan, they also had very strong earnings. It was more driven by investment banking and global markets, as I said. And in both cases, credit was solid. I think it was a little bit better at Citi. In both cases, they increased their provisions for credit losses going forward. In the case of JPMorgan, that seems to have just been conservatism related to tariffs, probably. In the case of Citi, there was a charge related to Russian client-related activity. That would be my one concern associated with Citi. But broadly, Citi put up a number as good as their first quarter in what's seasonally not as strong a quarter, and they've increased their guidance for full-year revenues. So it feels like Citi's put forward a very strong quarter, and JPMorgan, as it almost always does, has put forward a strong quarter as well.
Well, and both of those stocks have done quite well this year. I know we talk endlessly about Bitcoin and Nvidia, but you've got good old-fashioned big money center players that have put up some reasonable returns. We've even had technical analysts who have come on recently and said there's good momentum behind financials. What do you think sort of the broader recipe for investing looks like for the financial sector as we go through the rest of the year?
I think certainly one of the key elements to the continued strength of the financials has been the resilience of the U.S. economy. I think clearly unemployment has stayed relatively low. In fact, it was lower the last time at 4.1% since tariffs came on, and inflation has stayed steady. And these were two big concerns. It's not clear if they will remain as under control as they have been, but certainly provided that resilience stays to a fair extent and some of the benefits of deregulation, these merger and acquisition pipelines come forward, those should be stimulants for stronger earnings from the money center banks.